Hello, everybody. Happy Valentine's Day, and welcome to today's webinar all about fix and flip loans. As questions come up to you, this is a live interactive webinar. We want to make this as engaging for you as possible. So as questions come up, go ahead and use the little questions tab throughout the webinar. And what I'll do is I'll go ahead and ask the speakers your questions on your behalf. We're also going to have an extensive Q&A session at the end of the webinar. So please feel free to join for that as well. So with that, I'm going to turn it over to today's speakers. Jim, why don't you introduce yourself? Take it away.
Good morning, everyone, or good afternoon on the East Coast. Jim Voizard, LendSure, been here since 2015.
Nick?
Good afternoon and good morning. My name is Nick Teves. I'm an account executive with LendSure, and I have been here since 2021.
Andre?
Hello, everyone. My name is Andre. I run the underwriting group on the fix and flip side. So if you have any questions about the process, you're going to ask.
Awesome.
So today's agenda will consist of roughly a 30-minute presentation where Andre, Jim, and Rose and I will dive into a bit about LendSure, our fix and flip program, what that program really consists of, what our guidelines consist of, and what that loan process really looks like working with our fix and flip team. Additionally, we'll touch on some of the other loan opportunities we have to offer, why we think it's a great idea for you to work with us. I could say right off the cuff, we're definitely a service-oriented business. And at the end, we'll open it up to some question and answers where Jim, Andre, and I will be happy to answer.
Awesome. Oh, just a second. About us.
About us. So like I mentioned, I started in 15. This is Jim. We're headquartered in San Diego, but we have centers to serve you better across the U.S. We've securitized our loans for the last 6 years. I won't tell you how many billions, but it's in the billions. Good team here. This team's been together for years with this company and prior companies, presently lending all kinds of non-QM products in 47 states. Nick, you want to touch on that one?
Yeah, so a little bit about what we do and what non-QM really means to us. So we operate right on the cusp of what your conventional or conforming guidelines would be for your conventional lenders, for your Fannie Mae, Freddie Mac, FHA, or VA, whatever it is. And the reason I say we operate on the cusp is because what we do is we're determining the borrower's ability to repay differently. And you'll see that in our expanded guidelines. We have a variety of loan programs available where we're not qualifying the borrower's ability to repay based off of your standard income basis, right? So we have a couple of loan programs. I'll touch on them, and we'll dive into them a little deeper later. But bank statement loans, asset depletion. We have programs available for non-warrantable condos. So,
hey,
now.
Hey, Nick, do we sometimes we hear the term alt-doc or alt-documentation loans? So we look at what you just mentioned, bank statements, asset depletion, asset qualifier. There's situations that we look at that fail the Fannie Freddie rules and conventional things like employment gap. There might be a situation where someone was out of work, but got back in the same line of work. But we like the history. So we're an exception-based lender. A lot around employment situations falls our way if we can do those. We also use mixed income, it may be bank statements and an asset qualifier. But we'll touch more on that later.
Yeah, absolutely.
So this slide says the hot fix and flip market. What makes it so hot? Why is this market today somewhat on fire? We're busy. Our phones are ringing every day, every hour of every day on fix and flip scenarios. Why is that? One idea comes to mind is every house in Buffalo, New York, Cleveland, Ohio, and 3/4 of Philadelphia, Pennsylvania, Oceanside, California, North Smithfield, Rhode Island, Rochester, New York, every home you could name in those cities, because of their age, are candidates for a flip. And investors are now recognizing that and bringing loans. they're bringing requests because they need the financing to get it done. So there's a huge opportunity, lots of homes needing repairs, and people want to do these because they see a return on or an ROI, return on investment opportunity. The other side of it is mortgage bankers, brokers, loan officers. We're not that flooded today with 20, 30, 40 apps we're working on in a month. We're not that busy. Loan officers are attuned to this, and they're out looking for these loans, and they're available. So we're seeing that come to us in the form of lots of inquiries and lots of deals submitted every day. One of the first questions we get on an inquiry is, what's the interest rates? Rates range 10, 11%. Sometimes they're 10 to 11.5%. The focus on these really isn't so much the rate. These are 6-month loans, they're 4-month loans, they're 1-year notes. The term of the note's 1 year, it's interest only. But the wise flippers get these projects done inside of 6 months, so they're not paying interest that long. So interest rate becomes not a big deal. The focus has to be, did I buy their property for a price that allows me room to make money when I sell it? So what's the profit margin? So a good investor is looking at, how much can I make? What's the profit? Rule of thumb they use, a lot of them, 75% of the ARV, the after rehab value. They're going to look at that property to say, I'm going to pay you 75% of what I think I can sell it for, less cost. What does that mean? 400 grand loan at 75%. I'm sorry, a $400,000 loan value. ARV is 400. They're going to offer 300,000 max, less cost to fix it. Let's say cost are 50. That's a $250,000 offer to buy the property. The 250 from 400 leaves them a 150 spread. There's enough room in there, and Andre could go into details on flip economics. Does it make sense? We won't go into that much detail, but high level, that 150 spread, less interest cost, less carrying cost, less your ARV idea didn't quite work. It didn't sell for 400, it sold for 370. Using that 75% rule, less cost, you're still going to make a profit. So that's where we see a lot of these offers come in.
Awesome. And yeah, we're going to go into detail on what a deal looks like in a little bit. Jim?
What's the next slide? About LendSure's fix and flip program. Did we just mention this? Yes. One good thing about these loans, I'll talk about it. They're easy to underwrite. They're easy to do in the sense that there's no application per se. There's no 1003. There's no early. It's a mini app that will show you. There's no early payoffs. There's no prepayment penalties. There's no disclosures. There's no TRID, and there's no income. We're not computing a DTI. The loan is predicated primarily on the project itself, and does it make sense? We like to look at investors that have experience. They get a little better deals if they have experience. So the loan's not your typical underwrite situation. Exit strategy is twofold. It's usually a sale. Most of them are looking for profits at sale. Many investors will hold the property and turn it into a DSCR situation and live on the cash flow from the rents. Let's take a typical scenario, and we'll talk about loan to cost here. Loan to cost is vastly different than what we're all used to in this business, loan to value. $1 million house, I'm paying $1 million, I borrow 800,000. Okay, the LTV is 80%. That's what we do every day in our mortgage life. In the fix and flip world, it's a loan to cost situation. So here's one that's got a purchase price of $200,000. It's going to cost $60,000 to renovate it. So if I total those two numbers, my total cost is $260,000. So what's the relationship now between that cost and the LendSure loan that we produce on this? If we took $40,000 down payment, which we would, that's 20% down, that's $160,000. We lend the borrower another $60,000 to fix it. Your $220,000 in loan amount, and your cost is, I'm sorry, $260,000 in cost, and your loan amount is $220,000. So $220,000 divided by $260,000. Cost is $260,000, loan amount's $220,000. We're at 85% loan to cost. That's our max. Many deals, Andre, would you say they're more like 80%? Not
more
many are
like
at
80 to
85.
85%. Yes.
So that loan to cost is how we underwrite what most people think of as LTV. Now there's a final number we look at as well, and that's the after rehab value. We call it loan/ARV, loan to ARV. In this case, we got an ARV of 325, we got a 220 loan. So if it actually sells for 325, we're at 67.69% loan to ARV. So it's really not an LTV business, it's a loan to cost business. Andre, you want to add to that anything?
No, I think you stole all my lines. I don't even know what to talk about.
Program guidelines. Why don't you take that one over, because you know the guidelines.
Absolutely. Yeah, as Jim mentioned, we land on a cost basis, and the rule of thumb is we don't want to be more than 85% of the combined cost, which means we can land, let's say, 85% of the purchase price and 85% of the construction cost. That will take us to 85% total loan to cost. Or we can, for example, land 80% of the purchase price and 100% of the construction cost, like in a Jim's example, which would also take us to 85% of the total loan to cost, or any combination of purchase loan to cost and construction loan to cost. Typically, clients with extensive experience qualify for higher loan to cost ratio. Someone who's done, let's say, 5+ flips in the last 30 months would qualify for close to 85% combined cost. And someone with no experience or limited experience typically qualifies for less, I'd say around 75% loan to cost. And again, it can be a combination of, let's say, 75% of the purchase price and maybe 80 or 85% of the construction cost, depending on the flip economics. And though we look at the cost of the project and land primarily on the cost of the project, we also, as Jim mentioned, look at the after repair value. We want to make sure that there's enough profit left in a transaction for the value to be within 70% of the estimated after repair value, or the loan amount to be within 70% of the estimated after repair value. So we up to 85% of the total cost, and at the same time, that loan amount cannot be more than 70% of the after repair value.
And one of our goals is sorry, Andre, I wanted to say this because you're the one that taught me this. We want the investor to be successful, so they come back again to you and to LendSure. If they're successful, this is a repeat business. This is not a one and done. Investors go from one project to the next to the next. Until they lose money, then they're upset about their investment. They're upset with us. So we're interested in them being happy. We're happy. Everybody wins. We like the win-win situations.
Awesome. Guys, I'm going to go back to this previous slide just for a moment because Stacy wants to know where the 260,000 number is coming from.
So the numbers are coming from, and Jim, I'll steal that. The numbers are coming from the borrower. The borrower, when borrower comes to us with the project, they say, my goal is to buy that specific property for 200,000, and I spoke to my friend contractor, or I am a contractor myself, and I estimate it will cost me 60,000 to repair. So my total cost of the project between the acquisition and the repairs is 260,000. So as Jim mentioned, we look at that cost and we say, okay, based on the borrower's profile, based on the property itself, on the project complexity, how much can we lend on that cost basis? And in this example, we decided that we comfortable lending 80% of the purchase price, which is reflected in a 20% down payment, right, and 100% of the construction cost, which is for the total loan amount of 220.
So I would do this deal myself, Andre. If I could find a house I could buy for 200, put 60 in it, I'm all in, because that ROI, again, these are 4 to 6 month deals. your return is well above what you're going to get on Wall Street today, isn't it? What do you think about that, Nick? High returns.
Right. And the fix and flip loan is 12 months loan. When we look at the project from our seats, we look at a 12 months holding time. So we calculate the profitability based on the 12 months holding period, because it's a 12 months note. But in reality, if we look at this example, if it's an experienced borrower with a 60,000 construction project, it's not going to they're not going to hold it for 12 months. 60,000 renovation project, probably 3 to 4 months to complete and another 1 to 2 months to sell. So give or take, it's about 6 to 7 months holding period. So that will also impact the flip economics on the end.
And that's another reason, Andre, that $60,000 cost figure in this fast Freddie does his, call it his first flip. $60,000 is what he's estimating up front, and he asked us for that. So 60 grand is coming from labor. Labor's not cheap these days, we know that, and it's coming from materials, and materials aren't cheap. So what if they get into the project and they find something else wrong with the house underneath the foundation they didn't see on their initial walkthroughs? Now it's got to be 70,000 before they can get the thing cured and then on the market for sale. Again, that's why we like to see that cushion, so that they can handle the extra expense. It's not always what they dream of. Sometimes reality sets in. You peel back the onion, you see something new. Oh no! So we like to have a little cushion.
Hey, Jim, Philip wants to know if this is considered a commercial loan.
We do. Actually, the note that is signed is headed commercial note. Correct.
Fantastic. And what's the Jack wants to know what the maximum loan to ARV is.
70%. So in this example, we're lending maximum allowed on a loan to cost basis, 85%. And that 85% results in 67.69% of the after repair value. So we pass both checks that we established on our end, no more than 85% LTC and no more than 70% after repair.
Yeah, that's what Wendell is asking. Can we do a lower down payment up front?
It depends. Again, back to this specific example, if borrower qualifies for 85% total loan to cost, we could restructure it potentially with 15% down payment and 48,000, not 48, I'm sorry, what would that be? 51,000, right? The 15% towards the repairs, right? So we could potentially restructure it and lend 85% of the purchase and 85% of the construction. In this example, we just used 80% towards the purchase and 100% towards the construction. So we're still within the same 85% loan to cost total.
So Andre, let's talk about the process, how easy this is to get a application to you, and talk about the almighty term sheet that people need to see. And let's go there, because we love the term sheets getting out.
Sure, yes. The process is very different from what everyone is used to, I'm sure, because we do not, as Jim mentioned, we do not ask for the ERLA form. There's no 1003 to complete. There's a simple application that sits on the LendSure website. There's one for the purchase and construction and one for the refinance and construction. And pretty much both applications capture the same information we need on a project. One, it has 3 sections. Each application has 3 sections. One section is tell me about the borrower. And by that, I mean first name, last name, contact information, estimated credit score. We don't need the actual credit score at that stage, just the estimated credit score. Best if, of course, it's based on the recent credit report, but if not, a lot of borrowers, they estimate, they know what range their credit score is in. Then tell us about the experience, borrower's experience, how many flips they completed ever, how many flips they completed in the last 30 months, and just some additional information like any recent history of foreclosures, bankruptcies, etc. So that gives us an idea about the borrower, what kind of experience borrower has, and just in general, what the borrower would deal with.
What do you like for FICO, Andre? What do you like the score to be?
Above 660, and no no major issues. 800 is perfect. Anything above 720, usually we don't really ask any questions.
I would say in the last 25 years I've looked at, the average FICO is north of, in fact, I know it is. It's north of 700. So
yeah,
generally
absolutely.
speaking, these people come in, they've got a plan. If they've done 5 or 6 or 7, the local investor knows his market. He knows he's got good credit. They're going to make a decent offer because they understand the return part of this business. So the scores aren't typically a problem.
Now,
Scores are not a
Jim,
problem. Yep, go ahead.
Rhonda wants to know: do we provide the credit report, or do you pull it on your side?
Yes, I'll get to that in a second. So another section of the application captures the property details, and that is what's the property address, purchase price, construction cost, estimated after repair value, and some other details. But those are major items that we want to know about, because we want to know who the borrower is and what kind of project they're getting into, and so we can analyze the deal in its entirety. So
hey, do us a favor. Andre doesn't like this one. This is a tough one. Deal comes into us. They put all the facts on the page on the application, which is simple. They don't give us the address of the project. It's blank.
right.
The whole loan
Right.
is around the project. So until they get an address on there, I really don't want to submit it. And one other point on that. When that app comes in, there's a box that says, has your purchase agreement been accepted? Has your RPA, are you under agreement? You have a deal, buyer and seller have a deal. When we see that, we're moving fast, because that means there's a deal on the table, there's competitive bids, and we're on Andre to get a term sheet out same day.
Right.
Andre, I'm getting several. Oh, I'm sorry. I'm getting several questions about how do you determine what the after repair value is? Is it based on contractor things? Is it a some kind of appraisal? How do you guys determine what that will be?
Right. So first, probably let me go back to the first question about the credit. We will run the credit. The beauty of this program for brokers is you don't really need to click any buttons. We'll do all the work. Our team will process everything. We will run the credit. We will order appraisal. We will communicate with the title company on all the requirements. All we ask is your help gathering the documents from the borrower. So that's about the credit and who orders what. Regarding the after repair value, the estimate that is put in the application should come from the borrower. I hope that borrower has done some homework. They looked at the area, they want to buy the property, and they understand the market. They say, okay, we think that if we buy at a certain price and invest certain into the repairs, we will be able to sell it for this area. So that's what they put in the application. But then we actually check that after repair value through the appraisal. We will order appraisal, and we will request appraiser to provide two values. One is the as is to see if it makes sense to buy it at that purchase price. And the second value is the after repair value, which is based on the scope of work or scope of repairs that borrower provides us. So we will include that scope of repairs in our appraisal order, and appraiser will look at that scope of work and say, okay, based on this repairs, we think that the property will be brought to the C2 condition from the current C4 condition, or something like
that. Hey, Andre, can you read that?
It's EWAG.
Yeah, EWAGs don't really work in this business. That's the old term, estimated wild ass guess. So there has to be a little science around the ARV. When your app comes in, we see the address, we're gone to that neighborhood within the first 4 hours. We're going to look around at a few comps even before it gets to Andre's desk. So that's going to be an upfront observation we make real quick, because we want to get you guys quick answers. If the deal doesn't fit, we want you to know it that day. That's the goal. We want you to know it sooner versus later. The goal is to approve them all, but obviously we can't approve them all.
All right.
So this is the application I mentioned. As you can see, it's one-page form. We also ask for the broker detail section, so we can go back to the broker with the term sheet or with the questions about the project. We normally don't communicate with the borrower. We protect borrower interests, so we only communicate with the broker.
I did this form, Andre. I did it in test just before I got into this job, and I did one of these. Took me 5 minutes.
Yes.
And it worked because you turned me down like immediately. It was a fast turn down.
Okay.
And I'm getting a ton of questions. Yes, you are going to get a copy of the slide deck. Look for an email from me, Rose Waldy, about an hour after the webinar ends, and you're going to have that email is going to have a copy of the recording. It's going to have a link to the PDF of this presentation. So don't worry about taking too many notes. We've got you. And I'm also going to introduce a little infographic that we came up with just to help you with the high points of this that you can share with your borrowers if you need to.
Cool.
This is the refinance one. And
we got through that one.
So just briefly, to touch briefly on the process, I mentioned it's very different. So we will process everything. When we send out the term sheet and it gets back to us signed, we start the process. We run the credit at that stage. We run the background. If the credit and background are okay, there are no surprises. The immediate next step, we want to order appraisal and what we call the scope of work or the project feasibility inspection. For that, we need the purchase contract and the actual scope of work. So we order that. Our attorney reaches out to the client's title company that client picked for this project with title instructions. And so this parts of the appraisal, scope of work, and the title are probably the longest parts of the process. So around credit and background, it takes us a few minutes.
Hey, Andre, how long and how difficult are those scope of works? You call them SALs. Is that like a tedious process? What are you looking for?
We got a lot of questions on that as well.
Right. We're really just looking for the contractor's estimate. We want to see the GC that's on the deal that borrower hired for this project. We want to see the estimate, and then we'll pass it to the inspection, and we'll send it to the appraiser. That's what we want to see.
I've seen several of these. Typically, they're 1, 2, 3 pages long. They're not difficult.
It depends on the project. Some projects require more comprehensive, more detailed explanation of what will be done.
Well, Nick Teves right there. He's got one in Boston that we're all familiar with, right? Nick, it's a $1.3 million type loan amount for us. It's a $4 million ARV. It's a 10,000 square foot house in Lincoln, Massachusetts. It's a big job, and it's going to come out wonderful for this investor in the end when she gets the property sold. But the scope of work on that one from the licensed contractor is probably 20 pages long. It's a big job. It's $1 million in rehab funds, and it's moving. Nick, is it moving along? How's that loan doing?
It's moving along. It's been moving along nicely. I think we've all been working collectively to get it to the closing table just about as quickly as we can.
Andre, I've got about a dozen people asking whether the borrower can act as their own general contractor.
Good question.
If borrower is a GC, licensed contractor, Yes, they can. Depending on the project, Jim brought up this project in Massachusetts, for example. It's $1 million. It's actually 1.7 million construction, and if borrower is a GC and they can show us the experience doing this complex projects in the recent years, then sure, absolutely, they can be their own GC. But to give you an example, if the borrower just got their GC license and decided that they're going to be their own GC on such a complex project, we're probably going to have an issue. So it all depends on the specifics on the nature of the project itself. But yes, in general, borrower can act as their own GC if they are licensed, and depending on the complexity.
I've got someone let's see, Donna from Texas, and I think
Hey, we
Mike
love
from
Texas.
Ohio.
Let's go to
They say,
Texas.
well, they say it's both the same question, and in both their states, they're saying that GC licenses are not required in those states. What do you do at that
Yes.
point?
Right. So we have a vendor that does the contract review. Depending, like if it's a complex project, we will need to go through the contract review. And the vendor has a simple questionnaire for the contractor to fill out. And the questionnaire will capture the experience, years in business, etc. So we can understand the experience doing this type of projects. Again, it all goes back to, let me just say that fix and flip projects are unique. Each project is unique. There are no two similar projects, even for the same borrower. Same borrowers will get different terms, will get different underwriting, requirements. Might get different underwriting requirements or different contractor review or scope of work review, depending on the complexity.
No doubt about that. Every house is different. You look at these houses and you're like, wow, how'd this property get here? And now we're going to help fix it. Right, Andre?
Right.
Guys, are we ready for the next one? The next part?
Absolutely, yes. So let's assume we covered the credit, the background, we order appraisal, title, everything is in progress. Now we're collecting the rest of the documents, and one thing is we lend to LLCs only, or legal entities. This could be LLC or the corporations. So our borrower is technically a legal entity, which is backed by the guarantors or members of the LLC who act as personal guarantors on the loan. So the personal section, we underwrite the guarantor, but we're lending to an LLC. We don't look at income. We look at how much money clients have in the bank. And for that, we ask for last two bank statements. And we hope to see sufficient balances to support the project. Obviously, if client sends us 5,000 ending balance, then we're gonna ask for more bank statements until we get sufficient balances to cover the project. And by covering the cost of the project, I mean, we wanna see sufficient funds to bring to the closing table to put for the down payment to cover the closing fees. And we also want to see in reserves, they're not due at closing. We just want to see those funds in the reserves. That borrower has 3 months of interest-only payments and 25% of the total construction budget on the bank account. Because we want to make sure that borrowers able to close on the deal, pay the title company, pay our fees, cover the down payment, but then also they able to start paying the contractor to start doing the work and still able to cover the monthly payments, at least for 3 months.
Yeah, Andre, good point. The borrower has to have adequate funds. The last thing you want to get to is 7 months into it. I need $20,000 to finish the project. I don't have a dime left. So the house sits. And while it sits, they're paying us interest and they're paying taxes and they're paying insurance, and it sits. So the funding capability is critical to their own success. And again, we want them to win. We want us to win. We want win-wins. And we're not asking for a lot of reserves. I think you mentioned 3 months plus closing costs. But 2 months bank statements will tell us if they have it or they don't.
Jen,
Correct, right.
Go
do
ahead,
we
Rose.
do you guys need to source the large deposits in those accounts, or do you just take that the account that the money is there?
We do source the large deposits, yes.
Okay, great.
Sometimes letter of explanation is sufficient.
Okay, good.
Well, the next question is always define a large deposit. What's large?
Right. Well, it depends. I think, anything above 10,000, I would consider large. I've seen bank statements with multiple deposits below 10,000 on the same day in the same branch. So it might raise a red flag on my end, and I don't want to, because combined on its own, it's maybe 5,000 deposit, but combined on the same day in the same branch, it's more than 50. So that raises a red flag.
So Renee wants to know, so they need 25% of the construction costs plus 3 months interest only payments in addition to the down payment and closing costs?
Right, but again, just to be clear, the 3 months of interest only payments and the 25% of the construction budget is not due at closing. So they don't need to actually wire funds anywhere to cover this 25% in 3 months. The reason why we ask for those funds to be available is because closing on a property is easy. But it's the first step in the transaction. Now you need to bring that property to the after fair value, and in order to do that, you need to work with the contractor. Somebody needs to get paid to do the work, and you need to have funds available to cover that cost. And mortgage payments are still there; they didn't go away, right? So you need to cover those as well. That brings us to important part of the process is how the draws work, right? Because we holding back the construction funds. We're not advancing them at closing. We're only advancing the purchase loan component, while the construction funds, construction loan part sits on our end and it's disbursed in draws post closing, and it's advanced against the work completed and paid for, which means the contractor actually needs to install the windows, install the doors, do the demo, do the rough plumbing and electric, and needs to get paid by the borrower before borrower will receive a reimbursement from us. So that's why we ask for that cushion of 25% of the construction budget to be available on the client's bank account, because they need to start operating with some funds once they close.
Andre, can some of those funds be gifts?
Gift funds are acceptable on a case-by-case basis, yes. There needs to be, it's on a case-by-case basis. We need to understand the full picture of the project, the full picture of the borrower's financials, how much is being contributed by whom, and etc. So,
Andre, on that 25% of the construction funds, so construction budget was 50,000, 25% would be 12,500. Is that what you're saying?
correct, yes.
So that's not a lot of money. I mean, we're asking for 25% of 50, which is 12.5. If the people are broke, it's probably, you can't go to this being broke.
Correct, right. Because if borrower doesn't have money to begin the construction, then and says, well, I expect to receive a check from someone, in a month or two, then right away the project is stalled. Right away project is not moving forward. The second, what if borrower does not receive that payment, right? So it adds the uncertainty and adds to the timeline. So to avoid that, and it's common. It's common with all lenders that operate in that space to ask for a certain caution. Some actually ask for 50%. We just decided that we don't want to be that aggressive, and we think that 25% is sufficient.
So Andre, I got a couple of people asking whether things like retirement accounts, 401ks, IRAs, if they can be considered reserves?
They can, but we actually take them at 70 or 80% of the balance. So not everything is not the full 100% of the balance is accepted, but we prorate it at 80%.
Okay.
What's the next slide, Rose? Moving right along. Funding.
Funding.
Okay, he's touched on
The
that a little
funding
bit.
is we'll also we'll handle the funding as well. Our attorney, we hire an attorney that is well known in that space, and they're gonna handle the docs preparation. They're gonna distribute it to the title company, to the closing agent, and we'll handle the funding. Really, we do everything. You just I hope you sit back and enjoy the process and just help us to get the document.
And remember, there's no right to rescind here. There's no CDs. So the closing happens quick. There's not,
Yes.
You don't have waiting periods.
Okay. Then
Let's go to the next one. Okay, Nick's turn to talk a little bit. Nick's been quiet. This will be
I have. So aside from the fix and flip program, we do have, like I touched on before, a variety of other loan programs available. Some of my favorites being the foreign national loans. And Jim, I don't know how far in depth you want me to get into each of these. I could talk for hours just on the foreign national loans. But
20 seconds on each.
Foreign national loans are awesome. We can lend up to 75 LTV for, depending on what visa and what trade lines we're able to prove for those borrowers. We don't necessarily need U.S. credit for foreign nationals. That's about as deep as I'll go into those loans. Cash out loans on whether they be owner occupied or non-owner occupied properties up to 1 million. We will lend on Go ahead, Jim.
Did you say cash out?
I did say cash out.
Good. Fannie Mae made some changes this year on cash out limitations and cost to get a loan with cash out. And you mentioned $1 million. Man, I tell you, sometimes it's tough for people that own a $2 million house to go borrow $1 million. The bank just finds a way to say no. And it's only what, 50% loan to value, and they got an 802 FICO. That's a non-QM loan at LendSure. Call Nick Teves. He will help you out on that cash out loan.
I'd love to help you out on that $1 million 50 LTV cash out loan. Speaking of Fannie Mae guidelines changing, just last year, Fannie Mae changed their non-warrantable condo guidelines. We do love non-warrantable condos. We do them all the time. We can do them for investor programs or owner-occupied programs. Condo tels as well, and we also have the opportunity for 2 to 4 units and 5 to 8 units. Jim, anything to add for the 2 to 4 units or 5 to 8 units for fix and flip?
Well, in our fix and flip world, we stop at 4 units. In our non-QM world, we can look at 5 to 8. Second homes, love those loans. People that buy second homes typically have good down payments. They got good income. They typically have good credit. And we'll look at those, I think, up to 80 LTV, Nick. Got it. Now, here's one that's important. Bridge loans. That term's used 2 different ways. In the fix and flip world, bridge is talking about taking the house from its ugly state to before, and then to the, oh my God, look at it now. It's a beautiful house. Stop the car. We want to see this. So they bridged it with the repairs. In Nick's world of non-QM lending, bridge loans here talks about a move-up buyer. Very unique, something you could talk to about your realtors. Realtors aren't busy. Remember, I said 70% of realtors don't have a listing. They don't have a person to show a house to. They're not busy. Talk to them. Here's your chance this year is to talk to a realtor. 1, you got the bridge loan for move-up buyers. 2, you got the fix and flip program. They will let you in their door this year. They're not busy. So that bridge loan, taking the equity out of their current home, paying off the current first. The cash out helps them make the down payment on the new house. Nick will make the loan on the new house. So it's 2 loans. That bridge loan departing property is listed for sale. No payment on that loan. Great program for people that want to move up and go win the house, win the bid on the property they're trying to get, but they need the cash out first. So eliminate the contingency, call LendSure for a bridge. Works perfect.
Okay, great. And why partner with LendSure? Who's going to take this one?
I got a couple of reasons. Local AEs, account executives with 4, 5, 6, 7 years of experience at LendSure. So deep knowledge base, they understand what questions to ask a client up front, ties into our upfront pre-qual process, which is pretty in-depth. There just isn't that end of the 3-week ordeal, going to underwriting, something changed, your income's off, the debt ratio blows. Our account execs and our teams that work on those loans at the pre-qual stage get to an accurate number. The loan is smooth at the closing table. So that's one reason to partner with LendSure. Ops managers, operations people, we don't hide from loan officers. If you got questions, AE can't help, AE's busy, AE's on vacation, whatever. Our ops people are not hiding behind phones. They will work with you to get deals closed. Trust is the last one I'll mention, and then Nick, you can give us one. Trust is more important today than ever. We recognize the world. The loan office doesn't have 20 loans today. They may have 2. They have 4, may have 1. They have 2, and they got to place that loan. One's gone Fannie Mae. It's a DU underwrite, it's approved, and the other one's a non-QM deal. They're going to be careful who they send those 2 loans to. They're going to have to trust you. So we take a lot of pride in training our account execs on how to look at loans, how to look at credit, so you get a solid answer up front. Trust is everything. We get it. You have 2 loans. We get it.
Okay.
Yeah, touch on what you said earlier, Jim. Each of our each regional operations center is equipped with various sales teams, but each sales team is equipped with their own team of underwriters and an operations team. So the operations team and the sales team are working in tandem to be able to get those answers out to you as quickly as possible. So back to my point earlier, we are hypersensitive to service, or extremely service oriented.
Nick, what percentage of our loans get approved with at least one exception to our guideline?
About 30 to 40%.
Yeah, I think 40% is pretty accurate. And that's a compensating factor about the borrower that would offset the guideline miss. It might be it's a really, really low LTV, it's a really high FICO. They've got a lot of extra cash in the bank, but it misses some rule. We're notorious for doing that. Compensating factors gets deals done. We literally, in the last 24 months, we kind of got rid of the box checkers. We tried to hire, and we did hire people that can think through risk and what makes sense. So the box checkers went away, and we hired a whole lot of thinkers that can help you get your loan done.
Okay. So we've got a lot of questions. We will get through as many as we can today. Andre, what are the typical time for approval on a loan?
We try to get a term sheet out within a few hours. Sometimes we want to follow up with a few questions because maybe we don't entirely understand the project, so we go back to the broker to discuss some questions that we have. But usually no more than 24 hours we have a term sheet out, and in most cases it's within a few hours of the application received.
Donna wants to know, when and how do we get paid?
You get paid at closing by the borrower, so it's a borrower paid commission on the fix and flip project. So the broker's fee is added to the term sheet. The borrower knows exactly how much they're paying to LendSure, how much they're paying to the broker, and then when we send the lender figures to the title company, we also include a line in the email saying, please add the broker fee in the amount of such and such payable to that broker.
That's a great question on how they get paid. The typical industry historically, this fix and flip financing stuff was done a lot with private money and local people in local towns that had large bank accounts looking for 12, 14% returns on their money. So a lot of private financing. In the wholesale world, you dealing with LendSure, you're going to want 1 or 2 points. LendSure is also going to charge 1 or 2 points. We don't make a lot on these loans when we sell them. The interest goes to the investor. So part of our profit, a lot of our profit comes from us charging 1 to 2 points as well. So in the beginning, when you're talking with your borrower, if you're charging 2 and we're charging 1.5 or 2, that's 3.5 or 4 points. Can you sell that? Is the borrower going to pay 4 points? So it's better to have that discussion early versus late in the game so that you don't upset people and they understand what the costs really are. Again, I said earlier, the focus isn't the interest rate, maybe really not the points. Their focus has to be, I bought it for 200, I'm putting 50 in it, I sold it for 400. That's $150,000 of play money to go pay points with or whatever. So the focus has to be on the profitability of the project. That's how you win at this game.
So apparently great minds think alike, because I'm getting a lot of questions about, okay, your home is completed and it's done. What next? Do we offer an exit strategy? Can you turn that into a DSCR? What are the options for these people?
Right,
ahead,
and typically there are 2 exit strategies. One is to sell. Most investors operating in that space, they do that with intent to sell the property and to pay off the lender and to move to the next project. Others, what they do, they building the portfolio of rental properties, and we can certainly help there because we have the great DSCR program that we can offer to the existing borrowers.
Okay. And I'm sorry, a lot of these I got at the beginning and we already covered it. What's our maximum loan amount, assuming a 70 ARV?
Right, so the maximum loan amount dollar-wise is $1 million. At least that's what our guidelines say. But as Jim said, we out of the box lender, so we send term sheets with much larger amounts. So,
yeah, if we got a large loan and it's it's $1.8 million, we're going to talk to our investor up front.
yeah,
We
if
don't
it
want to
makes
be,
sense, it makes
right.
sense, and we're gonna send a term sheet.
But $2 million is the outer limit. So people that want to buy a property for $6 million and sell it for 10, that's not who we are. That's not us.
Right.
Okay, Daniel wants to know, do you order the appraisal AVM, or do we just leave income and employment blank?
So our application doesn't even have the field for the income and employment. So when you look at our application, you'll see that there's no room to put that information in. We don't care about it. We care about the assets. We care about the credit and that
And the project.
property appraises, right, for the right
Credit,
amount.
assets, project. Credit, assets, project. CAP.
I'm getting a lot of questions on draws and how the draws work, when and how, etc. Can you address that?
Right, absolutely. So as I mentioned, we advance for the work completed and paid for, which means when the borrower pay the contractor, the work's been done, or a portion of it, right? I'm not talking about the entire scope of work, but let's say borrower paid contractor to do the rough plumbing, rough electric, and do some demo, and it did cost borrower, let's say 10,000. They paid contractor, so now they submitting a draw request and saying, let's get reimbursed for that 10,000 I paid the contractor. We send inspector to the property to just note the progress. To
Take a picture.
Take pictures of the progress, right? They write us the report and they say, okay, we see that the rough plumbing, rough electric, and demo were completed. And they note the percent completion usually. And borrower separately sends us the invoice marked paid by the contractor for 10,000 that contractor received from the borrower. So between those two items, we know that the work's been done and paid. So we advance a certain percentage of that 10,000, and that percentage advance, that advance rate equals to loan to cost ratio of the construction loan to the construction cost. So if we're lending, let's say 60,000 on the 60,000 of construction cost, then it's 100% advance rate. If we're lending, for example, 48,000 on the 60,000 construction cost, it's 80% loan to cost ratio. So on each draw request, whatever the cost is, borrower should expect 80% back.
And how long does it take to get that wire out, Andre?
Between the inspections and all the documents, I'd say about a week, 5 business days.
Okay.
But once you get the invoice marked paid and a photo, you're good to wire.
Right.
So, what are our rates looking like today? That's from Martin.
Starting rate is about starting rate about 10.25, and that's for the lower LTC. As we get to the higher LTC, it climbs higher, but the average industry today is about 12 and 2, so 12%, 12+% and 2 points on average. That's the hard money average.
The interest rates on the last 100 people I've talked to on this, and that's been in the last 2 weeks, the rate's never the issue. It's the project itself and it's the points. So if you're charging 2 and we're charging 1.5, that's where you're going to have the conversation. That's where the issue is going to be. The rate, because it's a 3-month, 4-month, 6-month project, we're not having any resistance on rates. Fact is, a lot of people are surprised when we say between 10 and 11, between 10 and 11.5. But they're used to hearing 14 or 13.
Okay. So what about the, I'm getting several different ones about the qualifications that we require for a contractor. I know that we talked about states that don't have licenses for contractors, but people are asking, can it be a handyman? What other qualifications are required?
Again, it depends on the project. If we're talking about putting lipstick on a pig, it's one thing. If we're talking about doing a square footage addition, it's a different thing, right? So each project is unique. Depends on what are the project, what's the scope of the project. We'll know what to ask for. And if we have to do the full contractor review, the vendor will typically request the contractor's experience, the W-9, the past projects they completed, etc. The contact information, they're gonna ask for the contractor's driver license, so they run like a light background to make sure that there are no surprises there. Again, that's on complex projects. On most projects, we are okay with just an estimate and the contractor's license.
Andre, paint, carpet, and cleanup. The property's dirty, it's junky, so it's cleaned up, it's painted, and it's carpeted. Do we need a licensed contractor?
I'll say that on something like that, if borrower is a handyman and can show us that they maybe completed similar type of projects before, we'll okay them without being a contractor.
Good answer.
Without hiring. So, like, we try to be sensible here. If it makes sense for us to ask to understand who the contractor is, then we'll ask. But if we're not gonna just go and bother client or contractor, because it's just a paint job, right? We're not gonna make borrower go through the contractor if it's just a paint job. Right? And sometimes even like some projects will say, okay, here's the estimate from the contractor, but the roof guys I'm gonna hire separately. Okay, because you don't need to pay the contractor to go and hire a roof guy, because contractor is not a roof guy, right? So why do you need to pay contractor just to pick up the phone and call somebody if you can hire somebody separately. So we try to be sensible. That's what I'm trying to say.
Hey, Rose,
Yes, sir.
how you feeling?
I'm feeling good. I got to
Okay,
answer.
so let's do one more question, and then from that point on, account executives are available. Call them. Don't be afraid to call them. You got to call myself. I'm available. Nick's available if you're in the Boston, Rhode Island Northeast corridor. Call us. But we'll do one more question,
All
and
right,
we'll
I'll
wrap
do
things up.
one more. I'll answer one, and then I'll choose a, which is tough. Let's see. So I'm getting a lot of questions. Yes, you're going to get a copy of this slide deck, and yes, you're going to get a recording of the slide deck. Look for an email from me. If after this, if you still have questions or you think of something afterwards, just go ahead and reply to me to that email. I will answer the questions, or I will connect you with your LendSure account executive who can walk you through everything. And I'm asking a lot of questions. I'm getting a lot of questions about marketing materials. Are you guys going to have? Do you guys have anything on this? In the email that I send you, I'm going to include a link to our private label resource kit. There are fix and flip. Um, there's a fix and flip flyers that you can do, and there's even a fix and flip video that kind of takes you through the whole thing, that you can have somebody, I don't know, teenagers know how to do this, add your logo and stuff to the end of the video, and you have something that you can present to borrowers that shows them here's the whole process and how it works. So can you confirm that these are interest only loans?
Correct. This
Boom.
interest-only loans, 12 months term,
Correct.
and no
No
prepayment
prepays.
penalties.
No prepays.
Yes.
No no EPOs.
Right.
Okay.
So
Thanks a lot. Thanks a lot, Rose.
no problem. And so we mentioned non-warrantable condos earlier. I have got a couple of different questions on litigation, non-warrantable condos with litigation. Will we do those?
Tough. Those are tough.
So it's on a case-by-case basis?
Extremely tough. Yeah, we'd have to look at the lawsuit. That takes time. That's going to involve our attorneys. Active litigation is tough even on the non-QM side. It's even tougher on this side.
All right, sounds good. Okay, so that is it for the Q&A. Again, I have a question. I've got a copy of these questions, so I'll have the account executive reach out to you. Feel free to reach out to them directly or respond to me with that in that email that I'm going to send you in about an hour, and I will connect you with your LendSure account executive. I want to thank all of you for taking the time out of your day. Happy Valentine's Day again, for joining us on today's webinar. Jim, any last words?
Yeah, remember, every house in Buffalo, Rochester, Philadelphia, Cleveland, Cincinnati, Indianapolis, Detroit needs a flip. They need work. They're 85-year-old homes. Find your realtors, find these people, join an investment club in your community. This business is right in front of you.
Awesome. Nick,
Thanks for your time.
Nick, any last words?
Well, thank you, everyone. Appreciate you taking the time.
Awesome.
Thank you.
Andre?
Thank you. I'm available, by the way. If anybody wants to schedule a phone call or wants to get their team on a call and just to go through the details, I'm available. So hope to talk to you soon.
All right. Thank you so much, everybody.
Bye-bye.